Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Okay, so as of the close on Thursday, January 29th, 2026, shares of BURU Inc., that's ticker symbol BURU, are sitting at $0.1707 per share.
Which is a sharp drop.
It's a very sharp decline, yes. 7.23% from the session's high just a few hours earlier. And if you pull the lens back, the context is even starker. The stock has retreated, approximately 79.33% from its 52-week high of 85 cents. So we are looking at a stock that has just torched nearly 80% of its value in a year. It's in a precarious, falling short-term trend. But, there is a nuance in the data. While the price is dropping, volume has notably decreased on the last trading day of January against the 90-day average of roughly 106 million shares. In technical analysis, we often look for volume exhaustion to signal a bottom. The sellers might finally be running out of ammo.
Or it signals that buyers have simply left the building and turned off the lights. I mean, we are looking at a company with a market cap of $78 million that is effectively priced for perfection while at the same time signaling severe capital structure distress. So the central question we're debating today is, I think, unavoidable. Is BURU a distressed asset spiraling towards zero because of toxic financing and massive dilution? Or is it a severely mispriced defense and security hub that's in the middle of a high-stakes strategic pivot the market hasn't fully digested yet?
And I'm firmly in the latter camp. I believe the strategic transformation plan that they executed in January 2026, specifically the acquisitions of Orbit, Liocon, and the partnership with Techne, creates a valid, verified path to recurring revenue. The technology itself is validated by, industrial giants like GE and government agencies like NASA. The market is pricing in bankruptcy, but I think the operational reality suggests a massive pivot to defense.
And I look at the balance sheet and I just see a trap. I argue that the financial deterioration here it's terminal. The strategic transformation is frankly irrelevant if equity shareholders are wiped out by the capital structure. We have a massive dilution overhang from the Yorkville financing and a disconnect between a $78 million market cap and trailing 12-month revenue of just $9,300. That isn't a pivot. That is a valuation chasm.
See, you're fixating on the trailing financials, but looking backward misses the entire point of the January 2026 strategic execution milestones. You simply cannot value a company based on what it was, a hardware-only laser manufacturer, when it has fundamentally changed its entire DNA in the last 30 days. We are witnessing a transition into an integrated defense platform.
Okay.
Consider the specifics. In early January, BURU secured effective operating control of Orbit SRL. This isn't just another asset. This is a SaaS platform for operational resilience and risk intelligence. By acquiring a 22% stake with a path to 100% ownership by the end of the year, BURU is layering recurring subscription revenue onto its books. Then you add the acquisition of Liocon SRL, completed on January 20th. Liocon is a systems integrator. They actually make things. This reestablishes industrial revenue immediately.
But reestablishing revenue implies you had a healthy stream to begin with, which, let's be honest, BURU did not. You're talking about a company that generated less revenue last year than a kiosk at the mall.
It implies they are fixing the problem, and they are doing it aggressively. And the crown jewel here is the network contract with Technis SPA. This positions BURU for electronic warfare projects in Ukraine and defense vehicle contracts in Bangladesh. These are not hypothetical markets. They are active conflict zones requiring immediate hardware. The pivot is real.
The pivot might be real on paper, but the dilution is very real in the bank accounts of shareholders. I'm sorry, but I just cannot buy the bullish case when I look at the securities purchase agreement with Yorkville, specifically the YA2 PN entity. We have to be really precise about the numbers here because this is where the retail investor gets absolutely slaughtered. We are talking about a $25 million unsecured debenture and the registration of 230 million shares for resale. That is a staggering amount of paper hitting the market. But the detail that should terrify any long investor is the Series A warrants. They have an exercise price of 1 penny, $0.01. With the stock trading at 17 cents, the incentive for the lender to convert debt to equity and just sell immediately is overwhelming. The ceiling on this stock is capped by massive selling pressure from these debt-to-equity conversions.
I see why you think that. And the Yorkville facility is certainly expensive capital. It's undeniably toxic if you look at it in a vacuum. But let's look at what that capital actually bought. It bought a technical moat that is virtually impossible to replicate overnight. And this brings us to the core of the business, the relationship with GE Additive and NASA. We aren't talking about standard lasers here. We're talking about blue laser technology at the 450 nanometer wavelength. You have to understand the physics to understand the trade. Infrared lasers, which is what everyone else uses, operate at a wavelength that, well, it acts like a mirror when it hits copper or gold. It reflects. It's horribly inefficient. BURU's blue laser absorbs into these reflective metals 10 times more efficiently. It doesn't bounce off, it melts the material instantly. This is a physical advantage for 3D printing in aerospace. It allows for welding and printing speeds and material integrity that infrared simply cannot match. That is why they completed a U.S. Air Force contract. That is why GE Additive is a partner. This isn't financial engineering. It is a proprietary industrial advantage.
Technology is great, but governance determines if shareholders benefit from it. I come at it from a different angle. I want to investigate business relations. The corporate structure here it's a labyrinth. We have to talk about supply at EMI Capital, or SYEME, which is listed in London. Alessandro Zamboni, BURU's executive chairman, is central to both of these firms. BURU invested in SYEME's inventory monetization platform to fund Techne. So just think about how strange this is. You have a struggling U.S. laser company investing in a UK fintech platform to fund an Italian defense firm, all overseen by the same executive. To a retail investor, this looks like a circular flow of capital. It raises serious questions about conflicts of interest. Is this structure designed to build a defense hub, or is it designed to move capital between related entities?
It's a complex structure. I grant you that. But modern defense contracting is complex. The Techne partnership involves a €13 million convertible loan and a path to 27.9% ownership. This targets immediate defense spending. The use of SYME's platform was a mechanism to manage working capital for Techne, effectively using fintech to accelerate defense production. It's innovative, not nefarious. You're seeing a conspiracy. I'm seeing a way to fund manufacturing without waiting 6 months for a bank loan.
Innovative or not, the numbers have to make sense. Let's look at the valuation and do a proper peer comparison. You have BURU sitting at a $78 million market cap. If you compare that to IPG Photonics at $3.59 billion or Coherent at $20.7 billion, sure, it looks cheap, but that's a trap. BURU's EV to sales ratio is approximately 1,023 times. That is an absurdity. The market is pricing in absolute perfection for a company that has a current ratio of 0.27. That means for every dollar of short-term liability, they only have 27 cents of liquid assets. That is practically a textbook definition of insolvency risk. You cannot compare a company with $9,000 in trailing revenue to IPG Photonics, which generates over $1 billion.
That is such an unfair comparison. You're comparing a pivot stage microcap to mature legacy industrials. Of course, the multiples look skewed if you use trailing revenue for a company that just acquired its revenue stream this month. A much, much better comparison is Blue Glass Limited. They are another player in the defense and gallium nitride laser space. They are valued similarly. But BURU has the advantage of the civil to defense dual use path, which is exactly where the U.S. Department of Defense is allocating capital. BURU is an extreme early stage option on the defense sector. You are paying for the option value of the technology, not the trailing 12 months of sales.
Okay, buying an option is fine, but not when the mechanics of the market are rigged against you. Let's talk about the market mechanics, specifically the shorts and the dark pools. The technicals are just screaming sell. We have a Death Star signal that formed on the chart. That's when the 50-day moving average crashes down through the 200-day moving average. It's a massive psychological sell signal for algorithms, and it usually precedes a liquidity event. But deeper than that, look at the dark pool activity. Off-exchange short volume consistently exceeds 50% of the total volume. On January 28th, it was 51.52%. This suggests that institutional-grade skepticism is hiding off the lit exchanges. The quote-unquote smart money is shorting this company in venues where retail investors can't even see the order flow until it's too late.
I'm not convinced by that line of reasoning, because the days-to-cover ratio tells a completely different story. It is incredibly low. It's between 0.91 and 1.02 days. So that means the short interest, while it's present, it's not sticky. They're in and out. Furthermore, the official short interest of 5.45% has actually decreased by 18.8% since December. That suggests the bears are covering. And if we want to talk about smart money, let's look at the long side. UBS Group AG, they increased their position by over 10,000% to 4.39 million shares. UBS is not a retail day trader. When a major institution increases a position by that magnitude, they are betting on a turnaround. They see the asymmetry.
UBS might be hedging, or it might be part of some complex structured product. We just don't know their intent. What we do know is the intent of the people running the company. Insider activity has been zero. There's been no insider buying in the last 3 months. The executives, including Zamboni and Dario Barrassoni, they're relying on restricted stock units that only vest if the stock price hits specific thresholds. That's nice, but it is not the same as reaching into your own pocket and buying shares at 17 cents because you believe it's undervalued. If the people with the most information aren't buying, why should anyone listening?
Okay, look, the technicals are ugly and the balance sheet is terrifying. I'll give you that. So if you're long this stock, you aren't looking at the financials. You're looking for a geopolitical miracle. And that is where the prediction markets, specifically poly markets, start flashing red. And this is where the story gets really fascinating. We are seeing a parallel intelligence system emerging. On January 23rd, a poly market alert noted that the Department of War confirms existence of directed energy weapons. This correlates perfectly with NUBURU's specific tech, blue laser anti-UAV systems. And look at the partnership with Coeptus regarding AI and robotics. The prediction markets are signaling a long war scenario. The Russia-Ukraine ceasefire market only gives a 21.6% chance of peace by January 31st. That geopolitical instability supports the Techne electronic warfare order pipeline. The macro environment is practically begging for this technology.
That's a compelling narrative, I agree. But have you considered the other side of the prediction markets? Polymarket tracks risk just as well as it tracks conflict. We have to talk about the Italian golden power regulations. This is the state's power to block foreign control of strategic assets. Polymarket tracks Italian political stability and protectionism. So, if the Italian government decides that Techne or Orbit are too sensitive to be controlled by a U.S. firm with this kind of balance sheet, they can just block the integration. If that happens, the entire bullish thesis completely collapses. You are betting on Italian bureaucrats approving a deal with a financially distressed American microcap. This is the golden power rule. Rome can veto the whole thing. If that happens, NUBURU isn't just disappointed. They're left holding an empty bag with no revenue and a mountain of debt. The stock doesn't just dip, it evaporates.
It is a risk, but the alliance is already structured as a network contract to mitigate exactly that. They are navigating the regulations carefully.
Well, we're coming to the end here, and I have to reiterate my primary concern. The overhang is the deciding factor. Even if the tech works, even if the Italians approve the deal, you have 80 million shares issuable at 1 penny via the Yorkville warrants. That creates a mathematical barrier to price appreciation. Every single time the stock tries to rally, that debt converts and hits the bid. The company is effectively a going concern risk until it fixes its liquidity.
I acknowledge the liquidity risk, but I have to emphasize the asymmetry. This is a bet on operational resilience and directed energy. The company has successfully acquired revenue-generating assets in Orbit and Lyocon. They aren't just talking about it, they have signed the deals. If they survive this financing crunch, and with the UBS buy-in, I think they just might, the re-rating from a microcap to a legitimate defense player offers massive upside. The blue laser physics are a moat that capital structure alone cannot destroy.
And that really is the gamble, isn't it? Can they outrun their own dilution?
Exactly. The next few months depend entirely on whether that revenue scaling can outpace the speed of the dilution. It's a race between the engineers and the accountants.
A race we will definitely be watching very closely.
Absolutely. That's all for today.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.